Our top story today, U.S. stocks closed mixed today after the Fed left its key interest rate unchanged. The S&P 500 and the NASDAQ ended lower, while the Dow notched a modest gain here. The Fed's decision, as expected, they indicated that its next move will probably to cut rates. Now, here's a bit more on the details here. The Federal Open Markets Committee concluded its two-day monetary policy meeting. All of the members agreed, actually, to hold rates steady, which stands now at 5.25% to 5.50%. Now, at the conference, Chair Powell said that the central bank remains focused on bringing inflation back to its 2% target. He also dismissed the notion of an imminent rate hike. So here with me now live to digest the Fed's interest rate decision and Chair Powell's comments is the Chief Strategist at Mill Street Research, Sam Burns. Sam, how's it going?
Hi, Don. It's going well. Thanks for having me on.
All right, Sam. So, what stood out to you today? Help us parse through what Powell said.
I think today's, Fed meeting was one of those not as bad as people had been concerned it might be. I think some people, in the last few days had been concerned that the Fed would come out more hawkish, that they would be more concerned about the slightly higher than expected inflation readings we saw during the first quarter of the year, and that they would potentially even put rate hikes back on the table. But the statement and the press conference by Jay Powell both indicated that they were not considering any rate hikes. They were not particularly worried about the inflation data, that it really is merely a pause or sort of delay in the potential rate cuts that will come later in the year, rather than a reversal or a reason to really change policy. So it sounds like they're perfectly happy to kind of keep rates and keep policy where it is now. And then they took a step back on their quantitative tightening or their balance sheet runoff. That they're slowing that down some now, which the bond market seemed to like a little bit. So I think overall it was as expected or a little better than expected, but not as bad as some people had feared.
Well said here, Sam. But if you were to put a label on what Powell's remarks looked like, would you say it's leaning towards hawkish or dovish?
I would say, if anything, it was a little on the dovish side. Like I say, they're keeping rates neutral for now, and I think we'll probably for a little while longer. So it's not a big move either way, but it's consistent with what several of the Fed officials have said, which is to kind of keep rates where they are until we get greater confidence, in their words, that inflation is going to head back to the 2% target. And they didn't get that in the first quarter, but they expect that they will get it later in the year as we go forward. So I would consider it a little bit more dovish than people had been concerned about, but not extreme either way.
So Powell mentioned today about its balance sheet drawdown. Are there any liquidity issues in the system?
Not so far. I think the banking system and the credit markets and everything are still functioning pretty well. I think the Fed is a little bit nervous about running their balance sheet down too far too fast, because they did do that a number of years ago, back in like 2017, 2018. And at some point, the banking system reserves and things got a little too low and started to cause problems. So I think they're conscious of trying to avoid that, and by slowing down the pace of their balance sheet contraction, they give themselves kind of more latitude, more runway to avoid having to make big changes in the future if things do get a little bit tighter on reserves. So I think it's more of a precautionary step than anything else.
So, it seems like markets didn't complain too much about what they got from the Fed, right? Can you talk a little bit more about the market's reaction?
Yeah, no, today I think we saw that the market was somewhat relieved after the Fed meeting, and the bond market actually did, rally a little bit after the meeting and held that into the close. So the bond investors who are most sensitive to the Fed kind of had a relatively, positive view of it. The stock market kind of rallied and then sold off a bit towards the end of the day. But I think a lot of that was related to the tech sector, and particularly the semiconductor stocks, which are really not trading based on the Fed. They're trading based on their own news. There's concerns about valuations and some of the forecasts that some of the semiconductor stocks have issued recently. So I think that's more of a specific thing to that particular industry that's done extremely well until recently. and not really related to the Fed. So I think overall the response from the stock market to the Fed was kind of mixed to slightly positive, but that the parts of the tech sector got hit for their own reasons unrelated to the Fed, and the bond market seemed to be happy enough with it.
Well, all right, Sam, thank you very much for coming on today. Great insight. Hope to talk to you soon.
My pleasure. Thank you for having me.